Okay, Chris, so Treasury ETFs, $45 billion of inflows in the first quarter. Wow, I don't know when the last time I saw $45 billion in Treasuries. Corporate and high yield funds had outflows. Oceans of money is going into these Treasury bonds and Treasury ETFs. It's unusual to see all this money. What are the challenges of investing all this money? Is there an issue for the market handling this inflow? If this was a stock thing, we'd be debating, like, how are they going to handle? Where are they going to be putting all of this money? What happens now?
Well, I think, first of all, thanks for having me on the show today. I'm excited about what's ahead because I do think investors have rediscovered bonds. Given the rate of return that we're seeing from the bond market, given rates that the Fed has adjusted upwards. So I'm super excited what's ahead for the bond market, but the bond market can consume all this AUM. Over the last couple of years, electronic trading in the bond market has grown dramatically. It's now a third of the market. Market access is about 20% of the overall U.S. corporate market, and it's fully electronic and easily can consume that kind of AUM coming into the market.
I want to talk more about electronic trading and your role in that coming up. But Alex, we had you on a few months ago. You become a regular here. You hit the right the right spirit, the right ETF at the right moment. You were talking about your suite of on-the-run single-treasury ETFs. You added 5 new ETFs last week to complete your suite of offerings. We have to have the viewers understand what you're doing here. So explain how these single treasury ETFs work and what advantages are there in buying them over, say, buying treasuries directly.
Sure. So first of all, buying treasuries directly can be very hard. Go to treasurydirect.gov and try it for yourself. It's confusing. There's a lot of issues. And unlike, say, a stock, which is evergreen and you can buy the stock and you're done, bonds will eventually make their way to maturity. So a 2-year on-the-run bond today is not the same bond in 30 days or in 60 days or in 90 days. So there's inherently more trading action required to just hold on to the thing you thought you bought. And most investors don't want to put in that effort, or it's expensive to, or it requires professional skill to make that happen. So we launched these to replace the need to do that. So now, as opposed to creating a ladder, waiting for everything to come to the bottom of the ladder, you can just set the ladder and it will stay exactly where you want it to be. We take care of all the trading for you, and we do that in professional scale.
And it's just to explain to people, on the run, when you buy a 1-year treasury, you hold it to maturity, you get exactly the yield that you're buying. But in here, you're buying on the run treasury. So you're rolling over. 1 years have auctions every month.
Correct.
Right? So you're rolling over every month into the new one. So you're not necessarily going to get the same yield every single time that when you're rolling over into a new one.
That's right. You'll see some price action based on what the 1 year is trading at today, what you see printed on CNBC with some regularity. And the upside there is you're constantly getting that same exposure. So if you bought a 1 year and you're really happy with its yield today, and you wait a year, what do you do with that money? Now here you can choose that 1 year. You can also move up and down the spectrum now that we've launched all 10 of the key benchmark tenors.
It's 15 basis points, is that right?
15 basis points. And as opposed to some of the multi-bond funds that you'll see, which perform a different function, same price, but now much more surgical access to what you see on TV and what exposures you want to put in your portfolio.
Tom, I look at the quarterly numbers, which you provide, VettaFi provides me, $3 billion in outflows from U.S. equities last quarter, $45 billion in inflows into Treasury ETFs. We just talked about this. Your thoughts on this? Are we going to continue this tidal wave of money going into treasuries into the second quarter?
Well, the great thing, Bob, as you point out, you're finally getting paid for being invested in fixed income, where it's a lot different than a year ago. And when the 6-month is actually paying close to 5% and the 10-year is paying 3.5, it doesn't pay to take that added risk. So kind of what these gentlemen are talking about right now, it's worth getting paid. The other thing is we've seen almost $5 trillion now in money market funds. You're starting to get paid a little bit for that as well. But with the Fed balancing risk between fighting inflation and the banking conundrum we've got, along with trying to keep us out of recession, there's this tenuous period right now where a lot of people are kind of risk off. Hence, we've seen flows into ETFs that we haven't seen in a long, long time. And, you point out money going out of equities and into areas like treasuries or into areas like international funds that we haven't seen those types of flows in a long time because valuations are there, and guess what? People are looking for good value.
Yeah, I suppose I should highlight the fact that while we had $3 billion in outflows from U.S. equities, there was $29 billion in inflows into international equities. So here's two anomalies. We haven't seen notable inflows into international in ages, more than a decade, and we haven't seen these kinds of inflows into Treasury bonds in a long time. I gather people looked at the United States and said, maybe incorrectly, the chance of recession very high here, and maybe we should spread the money around a little bit that accounts for this inflow into international equities.
Yeah, I mean, I think you're dead on right. I mean, and when you look at, for example, the top holdings in the S&P, you've got Apple and Microsoft that are 13% of the overall weighting, and they were up 27 and 20%. You factor that in, and that was the lion's share of the S&P gain that we saw in the first quarter. International markets are off to a really good start off of the October lows and also year to date. So the pendulum may have swung here a little bit, Bob, and that's actually really good for investors, and it's really good for ETFs as well.
So I noticed, Tom, total ETF flows, everything, was $77 billion for the first quarter. At this time, this is well below the historic average, the Q1 average. We were doing north of $200 billion this time last year. And here's the numbers that we have. You gave me these numbers. Where's the rest of the inflows gone? I mean, you mentioned everybody hiding out in money market funds. Maybe that kind of accounts for this, but it's rather noticeable. After years of kind of steady inflows, we had this little brief hiccup. I guess the question is this going to continue? And is it right what you were saying here? It's all in money market funds right now.
Well, there's a lot in money market funds, and also in the last year, we've seen a lot of advisors take a little bit off the table, both on the equity side and the fixed income side. We've talked about the problems with the 60-40. And when you look at historically, I mean, last year we had $600 billion in new money into ETFs. In 2021, it was $900 billion. We're at a clip we'd be lucky if we make $350 billion at this point. So to the point of flows here, it may not mean that we see huge flows because there are alternatives. People might be buying individual issues in the bond market, and this is a great subject to talk about now. They may be going to money market funds and for the first time in years actually getting paid to be there. So safety is key until we start to see confidence that the Fed really has some handle on inflation and stability in the marketplace. And, we're really at a tenuous time right now.
Alex, I want to turn back to you. I often note, Tom and I joke about this, the new ETF offerings start out strong, but they fade because they buy at the top and when the things are hot, and they fade over time. But your first 5 Treasury ETFs that you had have raised more than $1 billion, right? Which is not bad for a Treasury ETF. Are you expecting, tell us what's happened the last week with your new suite of offerings.
Sure. So we hope we're not going to fade. So far, average daily volume is up every day, and I think investors have embraced the tool set we offer. And as a result, they demanded that we launch the rest of the key benchmark tenors. So we started off with a smattering, trying to figure out where did folks want to find yield, where were they comfortable buying treasuries. And they came to us and said, we want to buy middle of the curve. Yeah. We want to buy the long bonds. We want more duration. Maybe not today, but we know we're going to want it later this year.
Chris, I'm trying to look into the future because people are messaging me saying, okay, is this going to continue? Should I keep buying, Treasury ETFs? And I always joked about my mother a month ago called me from the bank saying, Robert, I'm getting 4% on she was rolling over a 1-year CD. She was getting 4%. She was astonished. It was the first time in a decade she'd gotten anything close, and she was amazed. And the bank tellers were giving her advice on, yields and things like that. And my mother's become a bond maven now. That's the top of the yield market if there ever was one. But it's a good question. My mother's paying attention now. And so is it reasonable to assume that 1-year treasuries aren't going to go back to 1%? That seems highly unlikely at this point. That's the question. My mother wants to know, Robert, is it reasonable, are we going to get 4% or 5%?
Well, I think we're about to see what I'd call bond renaissance. Bonds are suddenly very attractive. The stock market is having its own challenges. We've had a banking crisis, and I think that's some of the drive to the treasury market and the growth in inflows in treasury ETFs. I think your mom should start looking at some corporate bond ETFs in the market because some of the yield that we're seeing in those products. But truly, we're going to continue to see inflows. I think rates are going to remain quite high. We haven't gone through this cycle fully yet, and the Fed is still taking action. So I would expect bond yields overall to remain relatively high and attractive, and the stock market to have its own set of challenges.
Yeah, but corporate bonds haven't performed exactly the same way as high yield, or rather treasuries, though, Alex. Is there, obviously people were concerned about corporations in a recessionary environment, right. Bank bonds in a banking crisis. I mean, there's issues there that are sort of separate from that, corporate-wise. Can we make a distinction? You threw out the corporate bond things. I'm just riffing on you there, Chris.
Well, we clearly had challenges around the bank bonds that were in the corporate bond market. But if you look at the more liquid ETFs out on the market, we have Vanguard and State Street and iShares with some highly liquid ETFs. We worked with State Street in launching a new ETF, LQIG, which is 400 of the most liquid corporate bonds in the U.S. And the liquidity matters in this market.
Tom, you run VettaFi. I often say VettaFi does many things, but you're really an educational site for registered investment advisors and offer educational programs on what they should be looking at or advising their clients on or investing in. What are you hearing from the RIAs out there? I mean, these are the people that go out and buy these things on a professional level. Is the interest level continuing in bonds, or just riff on what you're seeing and trends in the second and third quarter for us?
Yeah, we're surveying advisors all the time, Bob, as you know, and a couple things. Those that had maybe stuck with the 60-40 allocation have gone through some pain, but they're also feeling a little bit more confident, as many are feeling that yields and rates are not going to be, they're going to be lower 12 months from now. So not only you're going to have less opportunity for yield, but you'll actually, if you're invested now, some opportunity for appreciation. There are a lot of advisors who took money off the sidelines, put money on the sidelines. They diversified a little bit, and kind of what Chris is saying, they're starting to move back in, not just into treasuries, but into corporates and high yields, with the idea that we may be able to lock in longer duration and longer payment for those higher rates, with the idea that we're not going to see higher rates a year from now. And that's, I think, key and critical. I think finally, to what Alex is talking about, being able to be in treasuries and get paid for it is great. Alex, briefly, if with that role, you're also susceptible to the appreciation and depreciation based on the ups and downs of the markets as well. So you're not holding that to maturity and getting and safely getting that yield. You do have some market exposure as well, right?
You do. When things go in your favor, rates come down, there's appreciation. We can roll it tax-free through ETF mechanisms, which is great for investors. But you do have some tail-end risk, and obviously the lower the duration, the lower that risk profile. That's why we've seen a lot of action into the short end of the curve. But now if you want to get paid long term, and there'll still be material yield in treasuries. I mean, we're looking at a very long-term stock bull market where folks just forgot bonds existed. Allocations were often 80-90% stocks, which doesn't make a lot of sense. Yeah, no. But there's still a material yield to be had there, and some duration risk to manage.
I would just point out, Tom, at the ETF conference that you run, last year, not this year's conference, but the 60-40 portfolio was declared dead, completely dead at that conference. And this year, the RIAs were scrambling to sort of re-expose themselves to a certain extent. February was a little early. It was before this banking crisis. But this goes to the Jack Bogle and me about having a long-term plan. Nobody could foresee these kinds of rate rises, but having a long-term plan. Now, you mentioned lower yields a year from now. You would have my mother's attention because she called me. Thank you, Mom. I'm bringing it up again. Robert, should I roll over my 1 year? She was rolling it over. Or should I make it 2 years? I said, the problem with the 1 year, Mom, is you have another risk. You have reinvestment risk. Right. Now, you don't know. You're going to get that money back. You don't know what the rates are going to be. Personally, I find 4%, 4.5% for 1 and 2 years, even if 2 years is a little lower, very attractive. Why don't you just consider getting a 2-year CD? She said, oh, well, you know, maybe I'll do that. And she was waiting. This was a week and a half ago for the yields to go back up again. She was hopeful. Again, playing that. But that's a good question now. The people who now have these advantages of, oh my gosh, I've got a 4%. Should I? What kind of maturity should I be playing with at this point?
Well, first of all,
Bob, you got to get your mom back on the show. You've got to get her on.
No, she's going to start giving you advice, Tom. That's we're not, and you're not putting her on Vetify either. We're not going to turn my mother. Then next thing, there'll be a TikTok video from my mother. No, we're not doing that. Go ahead.
I do love that your mom is arbing the fixed income market. Yeah. She's arbing the CD market.
She has another bank teller at another bank who is going to call her too. She has 2 bank tellers at 2 different banks giving her advice.
Well, there's so many tools available right now to invest in bonds. That's the beauty of all this. There's money market investments, there's direct investments, but the ETF provide the simplest tool to access the full fixed income market.
Yeah, lower yields though. See, that's an interesting question. So you have a chance to make a little money, but people, you know, like my mother, they don't hold on. They're not. They hold the maturity.
Right.
People that are out there. This has been a great conversation, guys. Thank you very much.